Apple is Warren Buffett's favorite stock, but not for the reasons that you might think. We're analyzing Apple's stock ticker AAPL to see if this great business is on sale. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Apple. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Apple for your stock portfolio. Before we get into these valuable metrics, let's understand Apple's stock performance. Right now, Apple trades for $195.66 per share. Year to date, Apple's beating the market. Their stock is up 57%. Apple's one of the magnificent 7 that's leading the charge in the S&P 500. In the last 5 years, Apple's stock price is up 278%. They're compounding at 30.5% annually. Their stock has more than quadrupled. In the last 10 years, Apple's compounding at 27.5% annually. Their stock is up more than 12 times. Going back before the global financial crisis, in the last 18.5 years, Apple's stock price is compounding at 30% annually. The company's stock price is up more than 127 times. Apple's far and away one of the best stocks over the last 2 decades. Right now, Apple pays a 0.47% dividend yield. Their average dividend yield is in addition to their returns in their stock price. Right now, Apple trades $1 below its 52-week high. The company's up $70 from their 52-week low. A little under 1% of their shares are sold short. Apple is one of the biggest businesses in the world. They have a $3.1 trillion market cap. They're the first company to trade for $3 trillion. Apple's Warren Buffett's largest stock position in his Berkshire Hathaway public stock portfolio. It makes up 46% of the portfolio that shows on his 13F. Right now, Berkshire Hathaway owns more than 5% of Apple's business. Warren Buffett first started buying into Apple in 2016. He spent about 3 years making steady investments into Apple before doing some slight trimming. Recently, he's been buying into Apple again. But the burning question is, why has Warren Buffett recently been buying more Apple shares? Apple designs a wide variety of consumer electronic devices, including the iPhone, iPad, Mac, Apple Watch, and AirPods, among others. In addition, Apple offers its customers a variety of services such as Apple Music, iCloud, Apple Care, Apple TV Plus, Apple Arcade, Apple Fitness, Apple Card, and Apple Pay. Apple's products include internally developed software and semiconductors, and the firm is well known for its integration of software, hardware, semiconductors, and services. Apple's products are distributed online as well through company-owned stores and third-party retailers. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want Apple's average return on capital in the last 5 years to be above 14%. The average business earns 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Apple earns very high returns on capital that have grown in all 5 of these years. In their last year, they earned 65% returns on capital. When these are averaged out in a given year, Apple's earning 44% returns on capital. That's more than 6 times better than an average business. This is a huge check on metric number 1. Metric number 2, we're looking for growth to go along with their high returns. We want to see 5-year revenue, net income, and free cash flow growth. All 3 need to be up for this to be a check. This metric's all or nothing. We'll include their numbers up until today in our calculations here. In this time, Apple's grown their revenues by 45%, their earnings have grown by 58%, and the company's free cash flows have grown by 52%. This is growth across the board, a big check on metric number 2. Metric number 3, we're looking at Apple from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. In our last metric, we learned their net incomes or their earnings have grown by 58%. At the same time, Apple's bought back 20% of their shares in the last 5 years alone. Between the strong earnings growth and these big share buybacks, Apple's grown their earnings per share. This is a big check on metric number 3. Apple's perfect through the first half of our analysis. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. A similar story here. Apple's grown their free cash flows, and with these share buybacks, that means they've grown their free cash flows per share. Another check on metric number 4 means, to recap, we're perfect through our first 4 metrics. We have 4 checks and 0 X's. But there's still one vital piece missing. You might think nailing returns on capital and having good growth is the key, but we haven't touched on the one thing that I believe sets Apple apart, which is having these without using a lot of debt. Metric number 5, we want Apple's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Apple has had negative net debt in all 5 of these years, meaning they have cash left over after paying off all their debts. Apple ended last year with $36 billion in cash. Right now they have $57 billion in cash. At the same time, Apple's generated $401 billion of free cash flow in their business. That's insane. Apple's one of the top cash flowing businesses in the entire world. With this big cash cushion on their balance sheet and strong cash flow, this is a huge check on metric number 5. Flawless through our first 5 metrics, does Apple have what it takes to be a perfect Select 6 stock? We'll find out, but we can't forget about our bonus. As our bonus, we're looking at Apple's dividend profile. Right now, Apple pays a 0.47% dividend yield. Their average dividend yield is in addition to their returns and their stock price. We want Apple's dividends to be supported by their free cash flows. That's easily been the case in all 5 of the last years. Apple has both grown their dividends per share and grown their free cash flows per share, maintaining a low and very reasonable dividend payout ratio. That's also the case today. This is a snapshot of their last 5 years of performance. It's no guarantee for the future. Apple's dividends look to be in good shape. This is a check on our bonus. The big metric of them all, metric number 6, we want Apple's average 5-year free cash flows divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Apple. Right now, Apple has a $3 trillion enterprise value. They're the first company in the world to trade at these levels. Enterprise value looks at Apple similar to it being a private company. It accounts for both their market cap and their net debt position. In the last 5 years, we learned Apple produced $401 billion of free cash flow, meaning they generate about $80 billion of free cash flow in an average year. When that's divided by their $3 trillion enterprise value, we get about a 2.7% average free cash flow to enterprise value yield. On a current basis, Apple produced $97.5 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, it gives us a 3.25% current free cash flow to enterprise value yield. Both of these are coming in below the yield of the 10-year treasury, meaning they're down from the risk premium we're looking for. Coming in all the way on metric number 6, this is our first and only X of the day for Apple. Don't just throw Apple out, we still need to estimate their fair value per share and give Apple our final rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Apple, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Apple's been a very predictable business in its past. That's not a guarantee for the future. Their business predictability informs our assumptions. Starting with an average of Apple's 3-year free cash flows, then using historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not for Apple. Assuming they grow the average of their last 3 fiscal years of free cash flow at 14% annually for the next 10 years, then assuming that this growth rate is cut in half and these grow at 7% annually in the decade from there, we're adding in Apple's tangible book value to give an estimate of their net worth. Keep in mind their tangible book value is skewed based on how the accounting is done for their share buybacks. This is likely understating it for Apple, which can impact their fair value. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, an estimate of Apple's fair value, if today's valuation multiples are the same 20 years from now, is around $93 per share. That's down more than half from their current stock price. Keep in mind some key points. Warren Buffett's recent small adds to Apple may be opportunity cost more than anything. He has over $120 billion sitting in cash at Berkshire Hathaway. He needs potential outlets to use that cash. Apple's a business that he knows very deeply and loves very dearly. His small adds can make sense from that perspective. Through Berkshire's purchase of Allegheny Corp, they also gained some more Apple shares. Apple was one of the only stocks Warren Buffett didn't totally sell from Allegheny's stock portfolio. Keep in mind, Apple's been a very predictable business in its past. That's not guaranteed for its future. This discount rate is an estimate of total returns to shareholders based on their free cash flows. It includes any gains in their stock price or the dividend yield that they pay to shareholders. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Apple, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for Apple's business. What are they? Looking at the factors supporting a long thesis, number one, Apple's still innovating with introductions of Apple Pay, Apple Watch, Apple TV, and AirPods. Each of these could drive incremental revenue, but more crucially, help to retain iPhone users over time. Number two, Apple's iPhone and iOS operating system have consistently been rated at the head of the pack in terms of customer loyalty, engagement, and security, which bodes well for long-term customer retention. Number three, between greater smartphone penetration in emerging markets and repeat sales to current customers, Apple has plenty of opportunity to reap the rewards of its iPhone business. But we'd be remiss if we didn't cover the negatives of Apple's business as well. Looking at the factors supporting a short thesis, number one, Apple is believed to be behind firms like Google and Amazon in artificial intelligence or AI, which could be problematic as tech firms look to integrate AI in order to deliver premium services to customers. Apple's most notable AI development, Siri voice recognition, they didn't develop Siri in-house. Number two, if Apple were ever to launch a buggy software update or subpar services, it could diminish the firm's reputation for building products that just work. Number three, Apple's decisions to maintain a premium pricing strategy may help fend off gross margin compression, but could limit unit sales growth as devices may be unaffordable for many customers. There you have it for a balanced perspective of some of Apple's qualitative factors. Now it's time to give our rating. In analyzing Apple's stock ticker AAPL, we learned their financials have many of the signs of being a wonderful company. It's no wonder it's one of Warren Buffett's crown jewels. Apple's a very beloved consumer electronics company that earns very high returns on capital. They've grown strongly. They bought back more than a fifth of their company in the last 5 years alone. They have a huge cash position and they generate a ton of free cash flow. They've also easily supported a growing and sustainable dividend. It's worth reiterating this analysis is not financial advice. However, right now, Apple doesn't look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis, if today's valuation multiples are the same 20 years into the future, based on today's assumptions, if you want a 15% rate of return, an estimate of Apple's fair value per share is around $93. Apple last traded at those levels in the summer of 2020. However, since then, both Warren Buffett and Li Lu have invested more into Apple. Again, this is not financial advice. Looking at all the factors of our analysis, Apple looks like a very strong candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Apple, and let me know what business to look at next in the comments below. Thanks for learning about Apple with me, and have a great day.